Here's something nobody tells you. The gap between the wealthy and everyone else isn't income. It isn't luck. It isn't even hard work. It's a completely different operating system running inside their heads. Most people spend their entire lives chasing money. Rich investors build systems that chase money for them. And the moment you understand why that distinction matters, everything changes. Today, we're breaking down the 7 rules that separate investor thinking from employee thinking. And I need you to pay close attention to Rule 5, because it's the one that quietly separates people who build generational wealth from people who stay stuck forever. Let's get into it. Rule 1. Think in assets, not paychecks. Most people wake up and ask one question: how much will I earn this month? Rich investors wake up and ask something completely different. How many assets do I own that earn without me? That one shift in question changes everything. An employee sees income as the destination. An investor sees income as fuel, raw material to be converted into something permanent, something that produces, something that compounds. Here's a mental model that will stick with you. Think of every dollar you own as a worker. An average person spends that worker immediately on rent, on food, on things that disappear. An investor hires that worker and puts them to work buying more workers. This isn't theory. This is why a person earning $50,000 a year and systematically converting it into assets can eventually outrun someone earning $200,000 who converts everything into lifestyle. Income is temporary, assets are forever. Stop chasing the paycheck. Start building the portfolio. Rule 2. Buy cash flow, not status. But here's where it gets interesting. Because most people, the moment they start earning more, don't buy assets. They buy identity, a newer car, a bigger apartment, a wardrobe that signals they've arrived. Rich investors think differently. They're not interested in what money looks like. They're obsessed with what money does. Cash flow is the heartbeat of wealth. It's the dividend hitting your account while you sleep. It's the rental income arriving on the first of the month. It's the royalty, the licensing fee, the business distribution, money that moves without you. Status is a liability disguised as success. It costs you every month. Cash flow pays you every month. There's a question the wealthy ask before every major purchase. Does this put money into my pocket or take it out? Most people never ask it. And that single habit, that single filter, is why some people build empires while others just look like they have. Rule 3. Think in decades, not months. Now, most people hear investing and immediately think short term. They want results in quarters, gains in months, proof that it's working now. Rich investors operate on a completely different timeline. They think in decades. Compound interest is the closest thing to a financial superpower that exists in the real world. But it requires one thing most people refuse to give it: time. Not weeks, not a year. Decades of uninterrupted, patient, boring accumulation. Warren Buffett made 97% of his net worth after the age of 65. Not because he suddenly got smarter at 65, because compound interest needed decades to reach critical mass, and he was patient enough to let it. The market doesn't reward urgency. It rewards patience dressed up as discipline. When average people see slow growth, they pull out. When investors see slow growth, they add more. That difference in response is worth millions over a lifetime. Play the long game, because most people won't. And that's exactly why it works. Rule 4. Focus on risk before reward. And here's the dangerous part. Most people think investing is about making money. It isn't. It's about surviving long enough to let compounding do the work. When average investors look at an opportunity, the first question they ask is, how much can I make? Rich investors ask a different question first. How much can I lose? This isn't pessimism, it's architecture. Wealthy investors understand that building wealth is not just about gaining ground, it's about never losing ground you can't recover from. Warren Buffett's two most famous rules are both about the same thing. Rule 1, never lose money. Rule 2, never forget Rule 1. There's a mathematical truth hiding inside that joke. If you lose 50% of your capital, you need to gain 100% just to break even. The math of loss is brutal and asymmetric. And most people never think about it until it's too late. Risk management isn't the boring part of investing. It is investing. Protect the downside obsessively, and the upside takes care of itself. Rule 5. See market crashes as opportunities now. Here it is. The rule that quietly separates wealth builders from wealth dreamers. When markets crash, most people panic. They watch the numbers fall. They feel the fear. They sell, locking in losses, exiting at the worst possible moment, swearing they'll never invest again. Rich investors feel the same fear. The difference? They act in the opposite direction. They buy. This is not recklessness. It's the logical conclusion of long-term thinking applied to short-term chaos. When quality assets go on sale, the only rational response, if you have time on your side, is to acquire more of them. The 2008 financial crisis wiped out millions. It also quietly made millionaires of people who had cash ready and conviction to deploy it. The COVID crash of 2020 terrified the world and handed disciplined investors one of the fastest recovery profits in market history. Every crash in history has eventually been erased by a new high. Every single one. The question isn't whether the market will recover. The question is, will you own anything when it does? Volatility is not the enemy. Fear of volatility is the enemy. Wealth is transferred during crashes, from the emotional to the prepared. Rule 6, use systems, not emotions. Because here's the problem with human beings. We are wired for survival, not for wealth. Fear, greed, impatience, excitement. Every emotional response we have to money evolved to protect us on a savanna 100,000 years ago. Not to build a portfolio in a volatile global market. Rich investors know they are not immune to emotion, so they do something elegant. They remove themselves from the equation entirely. Automatic investments that execute regardless of mood. Rebalancing rules that trigger based on logic, not anxiety. Buying criteria set in advance so that when opportunity appears, execution is mechanical. A system doesn't panic at a down market. A system doesn't get greedy at an all-time high. A system just executes. The most dangerous phrase in investing is, I'll make a decision when I feel ready, because you never will. The market doesn't wait for confidence. Discipline waits for no one. Build the system. Trust the system. Remove yourself from the daily noise. Rule 7, make money work harder than you do. And finally, the rule that ties everything together. Here is the uncomfortable truth about time. You can increase your income. You can optimize your schedule. But you cannot manufacture more hours. Every human being on earth has the same 24 hours. And there is a hard ceiling on how much any person can produce by trading their time for money. Rich investors know this, so they stop competing in that game and start playing a different one entirely. They build leverage. They deploy capital. They own pieces of businesses that employ hundreds of people, run 24 hours a day, 7 days a week, in markets around the world while they sleep. Their money doesn't rest. Their assets don't take weekends. Their systems don't get tired. This is not about avoiding hard work. Most wealthy investors work incredibly hard to build the foundation. But at some point, the goal shifts from working hard to making your money work harder than you ever could. That is the final unlock. The moment your money earns more than your effort, wealth stops being a destination and starts being a direction. Because one day you'll realize something. The goal was never to become rich. The goal was to become free. Free from panic. Free from survival. Free from trading your life for money. And investors understand that earlier than everyone else. Conclusion: 7 rules. 1 transformation. Think in assets. Chase cash flow over status. Play the decade-long game. Protect your downside before you dream about the upside. Welcome the chaos that terrifies everyone else. Build systems that think when your emotions can't. And make your money work so hard you can't keep up with it. This is not about becoming a different person. It's about seeing money with different eyes. Wealth isn't built by working harder. It's built by thinking differently. The investor mindset isn't reserved for the already rich. It's the reason they got there. And the moment you adopt it, even before you have the capital, everything around you starts to shift. Now it's your turn. Drop a comment below and tell me, which of these 7 rules hit you the hardest? Which one changed something in how you see money? If this video made you think differently, make sure you like it and subscribe to Wallet Mastery. This channel exists for one reason: to help you build real wealth and think smarter about money. One video at a time. We'll see you in the next one.